Hello everyone, welcome to Business Education and Research. This video presents the concepts of depreciation, different methods of calculations, and the importance of calculation of depreciation. Depreciation is a crucial concept in accounting, representing the gradual decrease in the value of assets over time. It allows businesses to accurately reflect the diminishing value of their assets on financial statements. For example, a company that owns machinery must account for depreciation to ensure its financial records reflects the true value of the machinery as it wears out over time. Depreciation refers to the systematic allocation of the cost of tangible assets over their useful lives. By recognizing depreciation, businesses adhere to the matching principle, ensuring that expenses are matched with the revenues they generate. For example, if a company purchases a delivery van for 20,000 and estimates its useful life as 5 years, it would depreciate the van by 4,000 each year to reflect its diminishing value on the balance sheet. The need for depreciation arises from the necessity to accurately represent the consumption of assets value over time. Without depreciation, financial statements would not reflect the true cost of doing businesses, leading to distorted profitability and asset values. For instance, a manufacturing company must depreciate its production equipment to allocate the cost of usage and ensure accurate reporting of profits. Depreciation is a fundamental component of financial reporting required by accounting standards such as GAAP or IFRS. Compliance with these standards ensure transparency and consistency in financial reporting across businesses. For example, a publicly traded company must adhere to GAAP principles when reporting its financial performance to shareholders and regulatory authorities. Depreciation plays a crucial role in tax planning as companies can deduct depreciation expenses from their taxable income, reducing their tax liabilities. This facilitates investment in assets and promotes economic growth. For example, a small business may use accelerated depreciation methods to maximize tax deductions and minimize its tax burden, thereby improving cash flow for investment. Straight line method of depreciation evenly allocates the cost of an asset over its useful life. For example, a company purchases a machine for 10,000 with a useful life of 5 years. The annual depreciation expenses would be 2,000. That is 10,000 divided by 5, you get 2,000 per year. Declining balance method of depreciation. Under this method, assets depreciate faster in early years and slower in later years. For example, a company buys a computer for 2,000 with a useful life of 5 years using 40% declining balance method. It would depreciate by 800 in the first year and 480 in the second year and so on. Units of production depreciation method. This method bases depreciation on the asset's usage or production levels. For example, a delivery truck depreciates based on the number of miles driven each year. If a truck is expected to last for 100,000 miles and it drives 10,000 miles in a year, it would depreciate by 10% of its total cost that year. Double declining balance depreciation. This accelerated depreciation method doubles the depreciation expenses compared to straight line depreciation. For example, if a machine costs 50,000 and has a useful life of 5 years, using double declining balance, the depreciation expense in the first year would be 20,000, that is 40% of 50,000. Sum of the years digits depreciation method. Sum of the years digits depreciation method accelerates depreciation by using a fraction of the asset's useful life. For example, if an asset has useful life of 5 years, the sum of the digits is 15, that is 1 plus 2 plus 3 plus 4 plus 5. In year 1, the depreciation would be 5 by 15 of the asset's cost. In year 2, 4 by 15 and so on. Selecting the appropriate depreciation method is crucial as its impact financial statements, tax obligations, and decision-making processes. For instance, a manufacturing company might opt for units production depreciation for machinery used in varying capacities, whereas a retail business might prefer straight line depreciation for its predictable assets usage. Now let us discuss the importance of calculating depreciation. To start with, let us see the impact on financial statements. Depreciation affects financial statements by reducing the reported value of assets on the balance sheet and increasing expenses on the income statement. This accurately reflects the consumption of assets value over time and helps in determining the true profitability of the business. For example, a company reporting depreciation expenses of 10,000 annually would see a corresponding reduction in net income. Depreciation ensures that the balance sheet accurately reflects the decreasing value of assets over time, helping stakeholders understand the true value of the company's assets. For example, if a company owns a building, depreciation expense reflects the gradual wear and tear of the building, maintaining its value on the balance sheet. Depreciation allows businesses to allocate the cost of an asset over its useful life, matching expenses with revenues generated by the assets. This aids in accurate financial reporting and decision making. For instance, a construction company can allocate the cost of heavy equipment over several years, reflecting the equipment's contribution to multiple projects. Proper depreciation accounting provides insights into the true cost of owning and operating assets, helping in investment decisions. For example, an investor considering purchasing shares in a company can analyze its depreciation policies to assess the ongoing cost associated with maintaining its assets base. Depreciation helps businesses plan for assets replacements by indicating the remaining useful life of assets. For example, if a company's delivery vehicles have depreciated to the point where their maintenance costs exceed the depreciation expense, it may be time to replace them. Accurate depreciation estimates facilitate budgeting and forecasting by providing insights into the future expenses related to assets maintenance and replacement. For instance, a utility company can forecast its future expenses for upgrading infrastructure based on the estimated depreciation of its existing assets. Depreciation affects the value of assets used as a collateral for loans, as lenders consider the remaining useful life and depreciation schedule of assets when assessing their value. For example, a company seeking a loan to expand its operations may use its machinery as collateral, with the lender considering the machinery's depreciation schedule to determine its value. Compliance with regulatory requirements regarding assets valuation and depreciation is essential for businesses to maintain transparency and avoid legal issues. For example, financial institutions must adhere to regulatory guidelines when reporting depreciation expenses to ensure accuracy and consistency in financial reporting. Depreciation impacts stakeholders such as shareholders, creditors, and investors by influencing financial performance metrics and assets valuation. For example, shareholders rely on accurate depreciation figures to assess the company's profitability and potential for future growth. Proper depreciation accounting helps manage risk associated with assets deterioration and technological obsolescence by ensuring timely replacement or upgrades. For instance, a technology company must depreciate its software assets to plan for upgrades and remain competitive in the market. Now let us see depreciation from auditors' perspective. Auditors evaluate the appropriateness of depreciation methods and calculations to ensure compliance with accounting standards and regulatory requirements. For example, auditors may review depreciation schedules to verify the accuracy of reported assets value and expenses. Different industries may have unique depreciation practices based on the nature of their assets and operations. For example, a mining company may use units of production depreciation for its equipment, while a software company may prefer straight-line depreciation for its intellectual property. Depreciation practices may vary across countries and regions due to differences in accounting standards, tax regulations, and cultural norms. For example, some countries may allow accelerated depreciation methods to incentivize investments in certain industries, while others may have stricter depreciation rules. In conclusion, depreciation is a fundamental concept in accounting and financial management, essential for accurate financial reporting, tax planning, and decision making. Businesses must carefully consider their depreciation policies to ensure compliance with the regulations and provide stakeholders with transparent and reliable financial information.